Thank you all for taking time out of your schedules to join us here for these 2 days. Many of you have come from across the country. Some of you have come from across oceans. Thank you for your interest in our work. One of the wonderful things about the work that we do is that it's so fun. Fun in testing ideas, fun looking at conventional wisdom and asking, is it correct? And often it is. But usually it's not been tested. And often it's not. So when you drill down and look at what people believe about markets, you often find, gosh, it doesn't stand up to simple empirical testing. When that happens, we publish it. And I've long since learned that when you publish something that challenges people's core beliefs, the reaction isn't, oh, wow, that's great. They're pissed off. They're really pissed off. This article, which came out in 1993, was greeted with a lot of anger in the active management community. Vanguard has used the article for years and years to promote the notion that indexing is the right answer. It's not quite what we said. What we said is that you can manage the tax alpha. Now, most investors, most investment managers, devote considerable resources in the quest for alpha, trying to find ways to add value, to boost performance. And then, as an afterthought, they think, okay, can I do some year-end tax loss harvesting? Can I do some year-end trading to trim the tax bill? Or maybe not even that. And so what I found interesting when we came out with this was that the reaction of the passive community was joy and enthusiasm, and the reaction in the active community was outrage. The other interesting thing was Charles Schwab personally ordered 25,000 reprints of the article to send out to clients. And there's nothing more flattering than something like that happening. This was an article that really drew attention to the fact that you can manage the tax alpha. You can manage the taxes down. Your after-tax return is the gross of fees return, the return that all of us see in institutional publications, minus fees. The net of fees, net of total expense ratio returns are what we see in mutual fund reports, minus the taxes on capital gains and dividends, which accrue year by year based on what dividends are paid out, net of fees, and what capital gains are realized on assets that are transacted, assets that have been sold, minus the taxes on capital gains after somebody eventually liquidates the portfolio and moves on to something else. The tax alpha is always negative, but it's very, very manageable. If somebody seeks to assiduously trim that tax alpha and reduce the tax burden for their investors, they will succeed. They will reduce the tax bill. If someone assiduously works to identify market inefficiencies and to earn a pre-tax alpha, there's maybe a 50-50 chance for the average asset manager to find those opportunities. There's maybe a better than 50-50 chance for those who are thoughtful in the design of product, but in any given year, it's not likely to be more than 60-40 for even the best asset managers. But the tax alpha, you can hit that 100% of the time and reduce it. Why on earth does our industry pay so little attention to tax alpha? One of the exhibits in our paper was this, which rattled a lot of cages and shocked a lot of people. As you go from no turnover at all, buy and hold, even index funds don't do that, to 100% turnover, at 100% turnover, 20 years on, your market value equals your cost basis. No surprise, because in that 20th year, you've had 100% turnover in the last year, so your cost basis does equal your market value. As you reduce the turnover, more and more of the portfolio is being allowed to grow tax deferred. Deferred taxes are an interest-free loan from the government. In a zero-yield world, that's not worth a lot, but that's probably temporary. And so when we look at the value of a free loan from the government that allows the portfolio to continue to grow without capital gains being realized, what you find is that the gap between market value and cost basis soars. If you invest $100 and if it grows at 6% a year, just a hypothetical return on the portfolio, at the end of 20 years, you're going to have $320 in value in the portfolio. The portfolio will have more than tripled, and that will be the size of your tax alpha accumulated during the ownership period. Now, when you sell the fund, you're going to realize capital gains, and you'll give up about a third of that. But giving up a third of that is still worth material, incremental benefit. And as you can see on this graph, the most shocking thing about this graph is how fast that tax benefit disappears as you start to introduce turnover. Even a 2 to 4% turnover that's typical of S&P 500 or Russell 1000 indexes is going to trim your tax benefit noticeably. And going from 5% to 10% doubles the endpoint cost of your tax burden. Going from 10 to 20 adds a similar increment. Going from 20 to 40 adds a similar increment. Notice the pattern. As you double the turnover, the incremental cost goes up by a similar amount. And so what we find is most of the damage in active management is done in the first 20% turnover. How many mutual funds have less than 20% turnover? These days, the average is north of 100. The alpha required to break even, net of tax consequences, if you have 100% turnover, is 323 basis points of alpha. How many active managers have that much skill? The alpha needed if your turnover is just 25% is 2/3 as large as if you turn over the portfolio constantly. The alpha, if you have 10% turnover, is 1/3, still over 100 basis points. So taxes exact a toll at very low levels of turnover. This was one of the things that also was quite jarring when this paper was published. We also looked back at the prior decade, 82 to 91, and asked the question, how many mutual funds beat the market? We used a very small universe. We used funds that had S&P 500 as the benchmark, that had existed for the whole 10-year span, that had at least 100 million in assets throughout the span. That's a lot of survivorship bias. Even with the survivorship bias, only 15 out of 71 funds managed to beat the market, and that's pre-tax, but it is net of fees. After you take out capital gains taxes, only 10 won. After you take out capital gains and dividends taxes, only 9 were able to beat the market. And once you liquidate, it pops back up to 13 because you're liquidating capital gains taxes will in some way be proportional to the amount of retained unrealized capital gains. So it's a little bit of a bounce back in terms of the effect on the portfolio. Well, we decided, actually at the suggestion of Trevor, who's here in the audience, to do a retrospective. We asked Journal of Portfolio Management, would you like us to do a quarter-century retrospective on is your alpha big enough to cover its taxes? And they were delighted. It comes out in the upcoming issue. So what is new since 1993? Tax-advantaged investing has a market. It has an audience. It has a cohort that looks for it and insists on it. Some of the obvious ones, deferral of capital gains, that's that wedge chart we were just looking at. Holding period management. If a stock has reached its target price, if you're one of those managers who says, here's an asset that I think is cheap, I think its target price is up 40%. If it's up 40% and it's 2 months away from going long term, do you want to liquidate it now and pay short-term capital gains, or do you want to roll the dice and say, from this target price, it could go up or down, I don't know which, and therefore it's worthwhile to wait. We did a paper back in the year 2000 in which we demonstrated through historical results that in almost all cases, well, I shouldn't say in almost all cases, on average, mutual fund managers would have been better off, or their clients would have been better off had they waited, because on average, the subsequent return on assets sold before that 1 year span, subsequent return to reach the long-term capital gains span was on average zero. Zero cost in terms of alpha, huge benefit in terms of tax alpha. Loss harvesting is now something that a lot of managers do. Parametric has made a business out of this. A lot of their business, I think over half of their business, has come to them because of their demonstrated expertise in loss harvesting. Lot selection. Most firms use either FIFO or average in, first out, average cost accounting, in the tax management of the portfolio. You can use HIFO, highest lot in, first out. When we started to manage the all-asset fund for PIMCO, launched back in 2002, I realized fairly early on that we had institutional investors and we had high net worth retail investors. And so I went to management at PIMCO and I said, why don't we switch this to HIFO accounting when I buy one of PIMCO's mutual funds because I like that asset class? After it's reached a price where our models no longer love the asset and want us to trim it, why don't we sell the highest cost basis lot first? And in so doing, we wound up making it moderately tax-friendly for the taxable investors at zero cost to the institutional investors who didn't care about the taxes. Wash sale management if you're running multiple portfolios, avoiding the situation where one manager sells, another buys in the same 30-day period, and any losses realized on the sale that you wanted to use to offset against gains elsewhere disappears. Yield management, dividend avoidance, a stock that's about to issue an unusually large dividend. Sell it and buy it 3 days later, and in so doing, you capture the dividend without receiving it. Now, of course, that only works if you don't have a large capital gain that you're realizing by selling the asset. The list goes on and on. Tax-efficient vehicles has been a big part of the evolution since 1993. Unbeknownst to me, and I was unaware of this for 2 or 3 years after it happened, the first US ETF was launched the same year we wrote that article. Now, ETFs are very, very interesting. I remember a guy named Herb Blank coming to me with religious fervor saying ETFs are the next revolution. And I missed that. I didn't realize how important it was going to be. The first exchange-traded note was launched a decade later. The first bond ETF in that same year, 2002. The first active ETF only 6 years after that. ETFs reached $1 trillion in assets just in 2010, only 8 years ago. And in addition to that, smart beta has become an enormous part of the business. Arguably, The first value ETF, many would say, is a form of smart beta. Russell claims that growth and value indexes are smart beta because they concentrate on a particular segment of the portfolio. Many of you know that I would disagree with that fairly strongly. The original definition of smart beta was strategies that break the link between the price of an asset and its weight in the portfolio. Why is that important? It's important because if you break the link, you're no longer assuredly going to own more of an asset just because it's gone up in price. Why would we want to do that? That's the Achilles heel of indexing. I have an article coming out in probably about 3 months entitled Buying High and Selling Low with Index Funds. It doesn't look at how easy it is to beat the index fund. Instead, it looks at the trading of index funds. Index funds do have turnover. There are stocks added to the index. There are stocks dropped from the index. Most of the time, those are corporate actions. They have no choice. Sometimes it's discretionary. The discretionary drops, the discretionary removals from S&P 500 and Russell 1000, on average are priced at half the market multiple. They're deeply out of favor, deep value stocks that are loathed. They've fallen in market capitalization enough that they don't meet the threshold for the index, and they're dropped. What replaces them? The additions to the index on average are priced at 1.5 times the market multiple. Now, of course, that's because the companies being added are really good companies with a terrific outlook. Otherwise, they wouldn't command premium multiples. And the stocks being dropped are troubled companies facing times of difficulty. Otherwise, they wouldn't be dropped. And so the question is, are these companies worth 3 times the valuation multiple of these companies? The simple answer is, well, what happens after the index has been changed? These underperform by 500 basis points in the next 12 months, the additions. The deletions, the discretionary deletions, outperform the market by 2,000 basis points. Sounds huge, but remember, they started out half the market multiple. On average, they go from half the market multiple to 60% the market multiple. That's all it takes to have a 20% return. And that's the average outcome, which means that mutual funds could deliver 2,000 basis points of alpha on the deletions just by deleting them a year later, and could add 500 basis points of alpha on the additions by buying them 1 year later. So an index fund, and that's times the turnover. The turnover is 3 to 5% on most index funds. Let's use 4% as an example. That's about right. At 4% turnover with a 2,500 basis point gap between the two, that's 100 basis points. Now, half of the deletions are not discretionary. They're corporate actions. You don't have a choice. So that takes it down from 100 basis points to 60 basis points. You want to find an index fund that beats the market reliably and relentlessly by about 60 basis points a year. Find an index fund that when S&P says we're changing the index a week from Thursday, simply puts a note on their post-it note on their calendar a year from that Thursday and says trade these now, and ignores the announcement of the change in the index. It'll come with tracking error, and that's the nemesis of index fund managers. But value ETFs, I don't think, are smart beta because they are capitalization weighted value indexes. That means that you are overweighting the overpriced value stocks and underweighting the underpriced value stocks. So yes, it's value. No, it's not smart beta. The first smart beta ETF that passes our definition of breaking the link with price was the equal weight ETF launched in 2003. The fundamental index concept was launched in 2004 and went live on institutional assets in 2004 and went live as an ETF in late 2005. That's the PRF. I love the ticker on that. It's the perfect PRF fund for long-term investors. Towers Watson coined the expression smart beta back in 2008. And when they coined that expression, they meant strategies that break the link with price. That definition has been stretched and stretched. Everybody suddenly wants to say we do smart beta, so it's been stretched to include cap-weighted value. Cap-weighted growth. How is that smart beta? Factor tilt strategies. Start with a cap-weighted portfolio and add a tilt. To my way of thinking, that's a tilted cap-weighted portfolio. If the tilt is profitable, it's smart, but not smart beta. If the tilt is unprofitable, well, that's stupid beta. The low-vol ETF was launched in 2011, and so-called smart beta ETFs hit $500 billion already 3 years ago, 2015. Now, what hasn't changed in the intervening quarter century? The most notable thing is that active managers still are challenged. They have trouble beating the market. I gave you an illustrative example of how to run an index fund with 60 basis points of alpha. Unfortunately, that also has 150 basis points of tracking error. It'll lose fairly big by the standards of an index fund in occasional years. So that's one of the challenges. You introduce tracking error. If you introduce tracking error, well, why not go with active management? Best answer to that is that most active managers suck. It's a technical term. Cap-weighted indexes are still hard to beat. Does that mean that they are difficult to beat from the vantage point of an investor who wants to beat the market using a disciplined technique? No. There are lots of disciplined techniques that for the patient investor will add value more often than not. 60% of the years, 70% of the rolling 3-year spans, 80% of the rolling 5-year spans. Now notice, 80% of the rolling 5-year spans means 20% of the time you're underwater after 5 years. How many investors hang on to a fund that's underperformed on a trailing 5-year basis? Why do active managers underperform? I think the biggest reason is that most of them are run by human beings who can't help themselves in chasing performance, chasing fads and bubbles, shunning assets after they've cratered, anchoring on cap weight because that's your benchmark. Gosh, Apple is 4% of the S&P. I think it's got a problem with an ability to move the needle at their current business size with innovations that are big enough to matter on a company with almost $1 trillion of market capitalization. How do you come up with an innovation big enough to move that needle? So, as a value manager, why don't I hold 3%? Because I don't want the tracking error. Well, if you don't like the stock, why own it? Why own it at all if you don't like the stock? I'm picking on Apple because they're number one, not because I think they're extravagantly overpriced. They're not. Trading costs. By definition, if you have 10 times the turnover of an index fund, you're going to have multiples of the trading cost. It won't be 10 times the trading cost. The dirty secret of indexing is that their trading costs are astronomical because they're all rushing through the same revolving door. Try to put 1,000 people through a revolving door at the same time. It's going to be a little messy. It might break the door. It might break the bank in terms of trading costs. Measured trading costs for index funds, when they trade relative to the date that the change in the index was announced, their average trading cost is about 500 basis points. Their saving grace is that the turnover is so low. Fees are higher. That also is an avoidable consequence. Talking about fees, the blue line shows active management fees average 110 basis points 10 years ago, average 2 years ago, 100 basis points. Fee pressure. Passive funds. Now, passive, this is how Morningstar defines passive, and it includes a lot of strategies that used to be active and rebranded themselves as passive. So there's some high fee funds in that list, but the average was 44 basis points back a decade ago and 39 basis points now. Again, about a 10% drop in fees. Smart beta hasn't come down in fees, but the median has. The median has. And speaking of medians, the active management funds have a wide distribution, a bell-shaped curve that's very symmetric, so the median almost exactly equals the average. Passive, median fees average fees 39 basis points, the median is 27. You have some passive funds with 100 basis point fees and higher. Oh my goodness. And smart beta, you have some that clearly think of themselves as active managers when they price the product, and others that don't. Interestingly, half of smart beta mutual funds have fees under 30 basis points. So now let's turn attention to what do we do about taxes? How do we reduce the exposure we have to tax obligations as a consequence of the active managers that we choose? First thing we did was to test the tax burden spanning 4,000 mutual funds, not 71 like the last test, 4,000 mutual funds over the last quarter century. Basically, every fund that was alive at least 2 calendar years, we included. So there's very little survivorship bias here. Why 2 years? Because in some cases we're using the first year to define the attributes of the fund and then measuring the performance in the second year. Gross return has a lot to do with taxes. The first rule of thumb is if you want to reduce the tax burden on your clients, deliver terrible performance, and it won't yield high taxes. I'm not sure many clients would like that strategy. But the tax alpha, in other words, the tax burden, turns out to be correlated to average annual return over the life of a fund with a 16.7% linkage. That means every 100 basis points of average return delivers 17 basis points of tax obligation. It sounds low, and it is low, and that's because of the interplay between losing years and winning years, losing funds and winning funds, and the implications associated with the portion of the portfolio that's held multiple years, allowing the tax obligation to grow tax advantage. So it's not as heavy as you'd think. 17% of the return disappears in alpha. You can see that in this dispersion graph. Now, the horizontal axis is the return over the quarter century. The vertical axis is the tax burden, what we call tax alpha. So the tax burden, when it's 1, 2, 3%, that means 1, 2, 3% negative alpha imposed as a consequence of taxes. I would draw your attention to right about the 9% line on the horizontal axis. There's a string of dots with the same return, some of which have a tax burden of 1.2%, some of which have a tax burden of 3.1%. There are passive funds with 200 basis points higher tax consequence than others. Look at the turnover, look at the trading cost management, look at the fees, look for hidden fees. 200 basis points difference in tax alpha on passive funds. Those are the orange dots. That's huge. Turnover. 21% times the turnover goes away in taxes. So here we're linearizing it instead of doing it on that curved scale that we saw on the graph. But if you just draw a line through it, what you find is that every 10% turnover costs you 21%. Let me do the math correctly. 21 basis points in incremental tax obligation. Dividend yield. Every 1% rise in the dividend yield of a fund costs you 12 basis points in incremental tax obligations, and that's on top of the gross return linkage. Fund size, here's a surprise. Every 10-fold increase in assets under management is going to cost you 11 basis points per year in incremental tax obligations. We then did a year-by-year test over the 25 years and repeated that study using funds that had lasted the whole quarter century, looking back retroactively and asking, what's the burden at the end of the 25 years? And that leads to somewhat different numbers, but the same general picture. Reducing the impact of taxes is easy. Here we're using the same universe, but focusing on the last 10 years, 2008 to 2017. We're breaking it into categories. Active, as categorized by Morningstar. Passive, as categorized by Morningstar, using their definition. Factor funds and smart beta funds. Now, what do we do with factor funds? Anything that has growth or value in the name, small or large in the name, quality or momentum in the name. These are the names of factors. So if somebody says Fidelity Deep Value Fund, okay, they're purporting to represent themselves as experts on one of the factors. Let's say you have somebody who says such and such momentum fund. They're purporting to represent themselves as experts on momentum. And so by using the name of the fund as the filter, we say any fund that purports to represent itself as having special expertise in one of the well-regarded and widely used factors, we're going to call them a factor fund. Smart beta, here what we do is we focus on breaking the link between the price of a stock and its weight in the portfolio. Three obvious categories are equal weight. If you're equally weighting stocks, you are breaking the link with price. You're introducing a huge small cap bias, but you're breaking the link with price. If you have a low vol strategy, in most cases, you're breaking the link with price. The price of a stock has very little to do with its weight in the portfolio. Its beta has a lot to do with its weight in the portfolio. You're loading up on low beta stocks. Fundamental index, weighting companies by the size of the business, not its popularity, not its valuation multiple, not its market cap, just how big is the business. Use that as an anchor, an economically meaningful anchor, to contra-trade against the market's constantly changing views. Now, if you do that, you have some companies trading at big premiums. I get it. Those are good companies. They deserve a premium. But you're using this as an anchor to reweight and rebalance the portfolio. So when you get a high-priced growth stock, the response is, oh, thank you very much for those gains. I'll take the gains and reweight it down. Because the good news that lies ahead, all of the good news that people are aware of, is already in the price. So the high price isn't going to help us. Low price, deep value stocks, feared and loathed companies with deep troubles. I get it. They're worth a lower multiple. That's fine. But we're using the size of the business as an anchor to contra-trade against the market's constantly changing views. We're saying thank you for the deep discount. Yeah, it's probably worth a discount. We don't know what the discount should be. It's probably worth a discount, but because bad news is already expected, it's in the price, so it's not going to hurt me on average to say thanks for the bargains, let me reweight upward. In so doing, you're taking the growth stocks down, the value stocks up. You're introducing a value tilt relative to the market, but it's a very special value tilt. It's a reciprocal of the market's willingness to pay a premium for growth. And that changes. The market sometimes pays a small premium for growth, sometimes a huge premium for growth. So fundamental index, if the market's paying a small premium for growth, takes on a small value tilt. If the market's paying a huge premium for growth as it was in 2000 and in early 2009, we have a stupendous value tilt. Huge, much deeper than the value indexes. We also throw in multi-factor in smart beta. Why? Because everyone thinks it's smart beta. All right, So let's drop it in there anyway. And, there, by the way, we're using the Morningstar definition of those funds. So what do we find? All funds, gross of fee, excess return relative to the S&P 500 is positive, 0.7%. That's pretty cool. Net of fees, it's gone. That's disappointing, but it is what it is. After taxes, after your year-by-year taxes from capital gains realized during the year and dividends, net of fees paid during the year, takes you down another 100 basis points. And when you eventually liquidate at the end of the 10 years, here we're using funds that existed for the entire 10-year span. So there's a survivorship bias, which is where much of that gross of fee alpha comes from. The funds with horrible performance died and aren't in our sample. But these survivors, after you pay the liquidation taxes at the end of the 10 years, you're 180 basis points underwater. All funds are broken by Morningstar into active and passive. Lo and behold, active and passive have the same return before fees. Well, active's actually a little better, but not by any statistically meaningful margin. Net of fees, the passive still has some alpha left. After fees, it doesn't. And after liquidation at the end of the 10 years, the passive takes a bigger hit from that endpoint liquidation because it's allowed the gains to accumulate tax deferred. Factor strategies, oopsie, those who say they're experts on momentum, those who say they're experts on value, on quality, they don't do a very good job. They underperform the others, and they charge big fees for that. So net of fees, they do worse. And they have relatively strong turnover, so their after-tax fees performance is worse, and after liquidation, they're worse. This is not an indictment of factor investing. This is a cautionary note. If somebody puts a factor label into the name of the fund, don't assume that they're experts on that factor. Study what they do and make your own assessment. Some of them are really good, some of them are really bad. Smart beta, using our definition, equal weight, fundamental index, low vol strategies, and anything that's multi-factor by Morningstar's definition, those funds on average added 0.5% gross of fees, added 40 basis points relative to passive, net of fees, almost break even relative to the S&P after tax, and after all fees liquidating at the end of the 10 years, give up only 1% of return relative to the S&P in taxes. The S&P itself gives up more than that in taxes. So this means that smart beta, as defined in this study, lives up to its name and actually is pretty darn good net of all trading costs. Why net of all trading costs? Because a lot of these are structured as low turnover strategies that have relatively light tax impact. Now, one very interesting thing to note is value has been crushed in the last 11 years. It's had an 11-year bear market. Value has underperformed growth by 300 basis points per annum for 11 years. That's the average. Best year was up 5, worst year was down 14. Okay, smart beta strategies, multi-factor, equal weight, fundamental index, low vol. Almost all of these have a value bias relative to the S&P. So this category outperformed even against a headwind, a hurricane force headwind, of value being savaged. I'm looking forward to seeing how it does in the next decade, because past is not prologue, and I'm thinking the coming decade is likely to be awfully good for value. Not all smart beta funds are created equal. We have multi-factor, equal weight, low vol, min-var, and fundamental index broken out separately. Now, kudos to PIMCO for boosting our fundamental index results, because RAE strategies, which used to be called enhanced RAFI, at PIMCO are also run with a plus, with PIMCO's bond alpha on top of the fundamental index alpha, and that's about a third of this aggregate that leads to the 3% alpha. So this is a little distorted upward by PIMCO plus strategies. But gross of fees, multi-factor, matches smart beta, equal weight doesn't, low vol min var most assuredly doesn't. Net of fees, smart beta and multi-factor are the same, equal weight gives up something, low vol min var gives up a lot, fundamental index gives up a little. After all taxes, while you still own the fund, smart beta winds up almost matching the S&P, multi-factor wins, low vol min var loses big, and fundamental index wins big. And after all taxes, once you liquidate, there's one category that actually beats the S&P, net of all fees over that 10-year span, and that's the fundamental index strategy. And again, thank you, PIMCO, for your portable alpha bump to fundamental index composite results. If we look at the attribution of return using the Fama-French methodology, here you're saying, okay, I get it. These strategies won, these strategies lost. Is it because their style was in favor or out of favor? Is it because they got a tailwind from their factor tilts? And what you find is, gross of fee, most of the categories are kind of neutral, net of Fama-French factor tilts. Factor is down 0.5%, smart beta is up 0.5%. After tax, before liquidation, they're all down about 2%, except passive and smart beta, which are down about half that. And after all taxes, including liquidation taxes, passive is still down 1.7%. Negative alpha net of Fama-French factor loadings, and smart beta negative 1.4. I said yesterday during one of the Q&A sessions, if you break even for your clients, it's a win. You throw taxes in there, if you break even, it's a home run. If you match markets, net of all fees and net of all taxes, you've achieved heroic results for your clients. It's kind of eye-opening. Let's talk about ETFs and what the future may have in store. ETFs are mutual funds. They're 40 Act mutual funds coming under the 40 Act, subject to all the same rules. And in fact, mutual funds can take in-kind contributions and can create liquidation units the same as ETFs do. They just generally don't do that. ETFs do it as a matter of practice, but mutual funds could. Typically low fees, mutual funds, wide range, ETFs, great majority of them are under 0.5%. Subject to cap gains and dividend taxes? Yeah, of course they are. Reducing capital gains for the ongoing shareholders, the patient long-term shareholders, by redeeming through liquidation units, mutual funds could do that, they don't. ETFs do as a matter of course. And they can use, both categories can use loss harvesting and lot selection. Most in both categories, sadly, don't do that. They should. The introduction of ETFs has offered long-term investors a powerful step forward. Now, when I emphasize long-term investors, most ETF investors use them as a trading vehicle. That's the wrong way to use an ETF. Do the tax advantages of an ETF accrue to people who use them as day trading vehicles? I don't think so. It accrues to the long-term investors. Now, here's a shocking statistic. Of all of the mutual funds in the market, how many of them have had no capital gains distributions in the history of the mutual fund? Less than 5%. ETFs, over half have had no capital gains distributions. The other half have had capital gains distributions in the 0 to 1% range in terms of the magnitude of tax impact they impose on their shareholders. And that gets you right about to the median for mutual funds. The average mutual fund delivers a tax burden from cap gains taxes of 0.9%. For ETFs, the average is 0. How can the average be 0 if half of them are in the 0 to 1 range? They're so far at the low end of that 0 to 1 range that the average is 0. How cool is that? So, as we shift our focus and ask the question, what about after dividend taxes? Mutual funds, 4.9% never made a cap gains distribution. Half of them also never made a dividend distribution, no income produced. Those would typically be hyper-growth funds that have a lot of commitments to zero-yield stocks or stocks with yields that are lower than the expense ratio of the fund. ETFs, not a lot, only 5% haven't delivered dividends, but the average tax burden from capital gains realized and dividends distributed for mutual funds rises from 0.9% to 1.1%. And remember, this isn't 1.1% in taxable benefit. This is 1.1% in tax that's paid out. You put $100,000 into the average mutual fund, on average you're paying $1,000 a year in incremental tax burden due to the way the fund is managed. ETFs, the average is 0.3. This is a big gap, 80 basis points. It dwarfs fee differences. How many of us, when we look at a mutual fund or an ETF, look closely at the fees? Show of hands, how many people pay close attention to fees? How many pay close attention to average taxable distributions in the past 5 to 10 years? About half. This is an informed audience. You should. It's bigger than the fees. I find it puzzling and amusing and a little bit annoying that investors will worry a great deal about 5 or 10 basis points of fee difference and not worry about 50 or 100 basis points of trading cost difference or 100 and 150 basis points of tax impact difference. Why on earth do people do that? Because the one number is so easy to find. So, the cheapest of the fundamental index ETFs is 25 basis points. The cheapest of the cap weight index funds is 3 basis points, 22 basis point difference. There's a lot of people who will say 25 is too much, not going to do it. And yet, if your tax burden alone is improved by that, which it is, and if the alpha, the pre-tax alpha, is boosted by 5 or 10 times that margin, and if the distributable tax consequences and trading costs associated with the strategy make up the difference, you've got benefits on all accounts. So just in conclusion, deferring taxes is like getting a free loan from the IRS. Like I said, it doesn't matter much in a zero-yield environment, but not realizing a gain and not paying the tax now means you're likely to pay the tax and realize the gain later. If it's much later, if turnover is less than 10%, so the holding period on average is over 10 years, it can be worth a lot. The tax burden can be reduced by limiting turnover. I've been astonished how many people jump onto some of the low vol and some of the min-var and some of the momentum strategies, not realizing that they're probably giving up 200 basis points a year in trading costs. Our Smart Beta interactive website shows the average momentum strategy has about 200 basis points annual trading costs. The average fundamental index strategy has about 2 basis points in average trading costs. That's huge, and it'll dwarf any fee difference you could possibly name. Smart Beta, correctly defined as strategies that break the link with price, Smart Beta is smart. That's why Towers Watson coined the expression. It was inspired by fundamental index, but it isn't limited to fundamental index. They saw that fundamental index wins Not at all because of the fundamentals. Fundamentals have nothing to do with the success of fundamental index strategies. It has everything to do with a rebalancing alpha as you set a fundamentally meaningful foundation for setting the weight and use that weight to contra-trade against the market's most extreme bets. What else does that? Equal weight does it, minimum variance does it, EDHEC's risk-efficient strategy does it, TOBAM's maximum diversification strategy does it. A lot of strategies. And that's smart because the rebalancing alpha is a reliable alpha. The last 10 years, a brutal span for fundamental index, we beat the market by a few tens of basis points in the US, over 100 basis points internationally, upwards of 200 basis points in emerging markets. And that's on live funded strategies, strategies that have a pronounced value tilt during a decade when growth beat value by 300 basis points a year. I count that as a huge win. Equal weight has had a similar result. Minvar and Loval, not so much. ETFs also provide tax efficiencies that mutual funds lack. Why? Most mutual funds have higher fees, higher trading costs, performance chasing, benchmark hugging, and they incur much higher tax obligations. So that concludes my formal remarks. Let's open it up to questions.